With us at Post 9 today is Wilmington Trust Head of Investment Strategy, Meghan Shue. It's great to have you on set, Meghan. Good to see you.
Thanks for having me.
First off, talk about what you're seeing next year, fixed income versus stocks.
Yeah, well, I think that as we look at the landscape going forward, where we've moved to in yields, and certainly we've come off a little bit, but with the 10-year around 4.5%, we're looking at fairly attractive risk versus reward for bonds. Rates could certainly move higher. It's really hard to know where they go from here. Growth is slowing, inflation is slowing, but financial conditions are incredibly important. And the easing of financial conditions that we've seen is a little bit circular because it could actually put the Fed back in action. So all of that withstanding, if you look at a potential move up in rates, we're probably going to see still positive returns for fixed income. And the likelihood that they move a little bit lower from here could see really solid gains. So we do like where we are in the fixed income space being overweight, but we're also not getting too negative on equities. And we think that you need to start thinking about inching back in. We've been underweight, but looking for an opportunity to get back to neutral.
We mentioned energy just now. What do you make of this pullback in crude?
I think it's really important to watch. So a lot of the focus has been on inflation. We are also shifting a little bit more of our focus towards what the growth outlook is going to be. I personally think that the move we're seeing in oil and small cap is a little bit of a warning sign for growth ahead and what could be coming on the demand side. It's certainly helpful for inflation and it's helpful for the consumer. But I don't love the signal it gives. So, we give about a 25% probability to a recession next year. Still have that base case being for a soft landing, but growth is slowing. And it's nice to call for and hope for a Goldilocks economy, but to see it slow to just the right pace is a small needle to thread. So I think we're just watching out for any signs of deterioration in consumer credit quality. And watching what oil is actually telling us as well.
When you say you like tech, is that a call on Magnificent Seven, which has done a lot of the heavy lifting this year for the NASDAQ, or something broader?
It is something broader. I think you need to be participating in mega cap tech because that has been the leader as we look at where the trend in technology is going in terms of structurally, when you think about AI and the importance of scale, the importance of really deep balance sheets. The Magnificent Seven is where it's at. And so I think you need to have exposure there. But we also look at valuations for the broader market, not only in tech, but outside of tech as well, as looking more and more attractive. And so I think there are some opportunities, especially within, active management, to pick your spots outside of what has just been dominating the index so far this year.
If you're overweight fixed income, wouldn't you want to be overweight small caps, or at least playing more within real estate, for example?
Well, small caps have been a really tough asset class. If you think about the NASDAQ being up 30% so far this year, S&P 500 up something like 15%, small cap is down. And again, I think that's another signal that there are some weak spots in the economy. I think from a valuation perspective, small caps are starting to get very enticing and very interesting. And you have to think about, from our perspective, going from an underweight to a neutral, I think is something that we're looking to do. But the trick is that we've seen such a pullback in some of these cyclical parts of the market. Generally, you'd expect small cap to bounce off the bottom. But if we don't get a recession, is it going to be more of a muddle through environment for small cap and maybe some of the most cyclical parts of the stock market more generally? I think it could be. And again, the power of scale and really sound balance sheets. If interest rates stay relatively elevated, that could continue to weigh on those smaller companies that are just more dependent on issuing debt and borrowing unless interest rates come really massively pulled back, and that's not our expectation.